Right. Good day, everyone. Today we are doing our last module, which is module 4, cost control. Cost control. Okay, let's go to the next slide. Right, let's go to the next slide. Okay, now the major focus of our module is on two methods of doing an income statement. There's two different methods whereby we do we do our income statement. So we are going to look at that, but firstly let's just look at this. We all know in the manufacturing business we have to calculate production cost. Okay, we have to calculate production cost. Okay, and then how do you get your production cost? Okay, we calculate production cost. Okay, how do you get your production cost? If you still remember, you take your your direct labor. Take your direct labor, you add your direct direct material plus direct labor plus manufacturing overheads. Okay, now you must also remember that your manufacturing overheads are divided into two. You have fixed manufacturing overheads and variable manufacturing overheads. Okay, that's the first start. You need to know the production cost, how you calculate it. You calculate it, you get it by adding direct material plus direct labor plus manufacturing overheads. Manufacturing overheads, which is divided into fixed and variable parts. Okay, now let's go to these two methods. Let's go to these two methods. Okay, right. Now the first one, we call it marginal method. Sometimes it's called direct method, sometimes it's called variable method. They mention it in different names, so don't be confused. So it's marginal, or it's direct, or it's variable cost method. The second one is called absorption cost method. Okay, so we are going to open an income statement using these two methods. All right, this is just an introduction. You need to know this. So what's the difference between these two methods? The only difference is in the treatment of your fixed costs. All right, how do these two methods treat fixed costs? One method recognizes fixed methods as part of production cost. One method let's take this method, absorption method. You can even tell absorption to absorb, to suck in, okay, to receive. So the absorption cost method, it recognizes fixed costs as part of what? As part of production costs. Right. All right. And then the second one, what's the difference with the second one? the marginal or direct or variable cost system does not recognize any fixed cost as part of production cost. Okay, now it may sound confusing, but don't worry, we are going to see when we do the actual book, which is the income statement. Right. Okay, now here they are trying to just to explain that is, according to the marginal or direct or variable method, fixed costs are written off as they occur, okay, separately. Okay, fixed manufacturing overheads are not considered as production cost, okay, but only all variable costs are considered as part of production cost. Okay, but the absorption method, what happens is that fixed costs are written off per unit produced. That means manufacturing overheads are considered to be production costs. Okay, you will see from the following slides. Okay, the major focus is that you have two methods, marginal or direct, and absorption. What is the difference? The difference is that this one absorbs or accepts fixed or recognizes fixed cost as part of production cost, but this one does not recognize any fixed cost as part of production cost. Okay, that's the major difference. Okay, let's go to the next slide. Now, before we move further, let's just show how the production cost is calculated. Okay, you know, production cost is made by adding direct material plus direct labor plus manufacturing overhead. Remember, manufacturing overhead is divided into fixed manufacturing overhead and variable manufacturing overhead. So when you add those, they give you the amount for manufacturing overheads. Okay, so you add direct material, direct labor, manufacturing overhead, they give you production cost. Okay, I hope this one is clear and simple. All right, let's go to the next slide. All right, now if you can see here, we have a comparison of these two methods. Opening the two income statements. Now let me take you back. Remember, your normal financial income statement, you will say sales less cost of sales equals gross profit, isn't it? But now, since we are in the production or manufacturing business, instead of having cost of sales, we are going to have production cost. Okay, because we are producing, so we have to calculate the cost of producing. All right, it's unlike the trading whereby we buy and sell. Otherwise we were going to say sales minus cost of sales equals to gross profit, but here we are dealing with the manufacturing or production business, so we have to show the production cost, which is made by direct labor, direct material, manufacturing overhead, of which manufacturing overhead is divided into fixed part and variable part. All right. Now let's start with the absorption one. What did we say the absorption method focuses on? We said it absorbs or it accepts or it recognizes fixed manufacturing overhead as part of production costs. Okay, so let's start from the beginning. Our sales equals 100,000 less production cost. Okay, because we are in a producing business, not in a trading business. So less our production cost, which is made by direct material 15,000, direct labor 15,000, manufacturing overheads is 5,000, which is made by the fixed part of it and the variable part of it. 2,000 plus 3,000 is 5,000. So when you add this, they give you your production cost, which is 35,000. And then you say sales 100,000 minus your production cost, which is 35. Your gross profit is 65,000. Right. So after your gross profit, then you minus your selling and admin costs, which they also have a variable part and a fixed part. Okay, so variable part is 1.5, fixed part is 2,000. So your selling and admin cost is 3.5. You minus it from here, and then you get your net profit. All right. It's a pity, guys, that you are not here. We were going to do question papers so that you can see how this is examined. Now we are done with the absorption. Then we do the marginal or direct or variable method. Remember, if you are doing both methods, your net profit must be equal. Otherwise, if the other method's net profit is not equal to the other one, there's something wrong that we have done in either of them, in one of or the other. Right. Now let's go to marginal or direct method. Same thing here also. This is the income statement. Is your sales, which is 100,000. I'm sorry, this 100 was supposed to be here, like here. Okay, 100,000 less your production cost. Remember, your production cost is made by direct material, direct labor, and manufacturing overheads. And remember, your manufacturing overheads is divided into two, the fixed part and the variable part. Don't forget that. So let's see here. So your production cost is made by your direct material 15,000, same way as this one. Direct labor 15,000, the same way as that side. And then remember, this method says we don't recognize any fixed costs as part of production cost. So we only recognize variable parts. We only recognize variable costs. Okay. So you say also a variable cost, which is made by the variable part of the manufacturing overhead. If you look here, your manufacturing overhead, your variable part was 3,000. So manufacturing overhead, the variable part is 3,000. Also, you look for other variable costs. If you check here, your selling and admin has a variable part and a fixed part. So you take that variable, right there, 1.5. You add all the variable, so and then you get 4.5. So this method says the only costs that we recognize as part of production cost in this method are the variable costs, not the fixed costs. The fixed cost cannot be part of the production cost. That's what they say, right? And then your variable parts, your variable costs, they give you 4.5. When you add this, they give you this, and then your production cost, which is 34,500, you deduct it from your sales, and then you get your gross income. Sorry, you get your marginal income. Remember, with this method, you have the gross profit, but with this method, you have your marginal income. don't confuse them, is your marginal income, right? And then after your marginal income, you minus all the fixed costs. Okay, so all the fixed costs are deducted here separately, right? Separately. So what fixed cost do we have? If you look at this, we have manufacturing overheads, the fixed cost, the fixed part of it. So it's 2,000. We have manufacturing overhead 2,000. Where can we get other fixed costs? Selling admin costs, we have a fixed part. Selling admin cost is 2,000. So our fixed cost is 4,000. You minus them from your marginal income, they give you 6,500. So this net profit, whether you use whichever method, the net profit must be the same. Okay. All right. I hope that is clear, guys. This needs a lot of practicing on the question paper. Okay, let's go to the next slide. All right. Now, please check the examples on your notes for Unit 4.2, Unit 4.2, Unit 4.2. All right. Now, the advantages and disadvantages of using direct costing method and disadvantages is self-study, guys. You can get them in your book or in your notes. Okay, it's self-study. Okay, let's go to the next slide. Right. Now we are done with the income statement, whereby we used the absorption method and the direct or variable or marginal method. We are done with that. Now we are coming to another section now, whereby we will calculate what is called break-even quantity, break-even value, and then we draw a break-even graph, whereby we are going to show this, what is called safety margin. Right. Firstly, what is a break-even quantity? So it means how many units must the business sell to break even. Do we all know what do we mean by break even? To break even, it means like an equilibrium. It means the business has not made any profit. It has also not suffered any loss. All right, so profit is 0 and loss is 0. Okay, so what is the break-even quantity? So how many units must the business sell to break even? Okay, what does that mean? It simply means for the company not to make a profit or loss, they have to sell so much, maybe say 20,000 units. So when the business sells 20,000, that business sells 20,000 units, they know they are not going to suffer any loss, they are not going to make any profits. That's a break-even quantity, right? Okay, there's a formula, okay, because we always have calculations. There's a formula to calculate a break-even quantity. The formula is your total fixed cost. Okay, let's use this. Okay, it's your total fixed cost divided by your marginal income per unit. Okay, that's your formula. The formula to calculate quantity, break-even quantity, you take your total fixed cost, you divide it by your marginal income per unit. Most of the time they don't give you straight your marginal income per unit. Okay, they want you to calculate it. This one, they don't give you. How do you calculate it? you simply take your selling price per unit, you minus your cost price per unit. Simple as that, guys. Definitely this information they are going to give you. Definitely this information they are going to give you so that you can be able to calculate this. So don't forget, your marginal income per unit is calculated by using your selling price per unit minus your cost price per unit. Okay, please don't forget. Right? So you know how to calculate your break-even quantity, and then you go to your break-even value. Okay, your break-even value. So that simply means when we sell those break-even quantity, in our example, let's say it's 20,000. That means you are not going to make any profit, you are not going to make any loss. Okay, any loss. But how much in terms of rents, in terms of value, are you going to get? So this is what you are calculating here. This is what we are calculating here. So what does it mean? It means the rent value of sales that the business must make to break even, right? The formula is also simple. You take the break even quantity that you calculated above, quantity. Okay, remember the one that you calculated above, that total, let's say that total is 20,000. Okay, you take it, you multiply by selling price per unit. Break-even quantity you multiply it by selling price per unit. Please guys, when you write the formulas in the exam, you can write this, right? You can write this if you want, but I prefer, like these ones. Okay, you multiply by selling price per unit. Let's say selling price per unit is 20 rand 30 cents. 20 rand 30 cents. Okay, so whatever money you get here, let's say is 158. I'm just making an example. 150,600. That's your answer. Okay, so it means that when you sell 20,000, you are not making any profit or not incurring any loss. The money, when you sell this value, these units, the money you are going to receive is 150,600 rand. Okay. Another formula. So there are two formulas there to calculate, because it will depend on the information given to you in the question paper. Which information do you have? Okay, maybe in the question paper you will have this information, you will have this one. Sometimes you don't have some of this information, but you have some of this information, you have it. So you need to use this formula. So the other formula you can use is this one, depending on the information given to you on the question paper. Is your fixed cost. Okay, so fixed cost divided by marginal income, not per unit, marginal income ratio. A ratio is a percentage, most guys, I think, right? Ratio. Right. So this is the information. This is the formula. Your fixed cost divided by marginal income ratio. Okay. most of the time they don't give you the ratio. You have to calculate it. You have to calculate the ratio, the marginal income ratio. Right, how do you calculate it? Okay, you take your sales, minus variable costs, okay, times 100 divided by sales. Okay, right. Okay, right, so you know your break-even quantity, your break-even value, and then the next slide, safety margin. Safety margin. Safety margin. So the term safety, you understand, simply means you are okay, you are safe, you are in a good position. So safety margin, what do we mean here? We simply mean a safety margin is where a business is in a good position, is making profits. All right, remember we talked about break even. All right, so when we say break even, we mean the business has not made any profit, has not incurred any loss. Right, so the moment the business start making profit, that we call safety margin. Right, that means the business is safe. Okay, is in a safe position. Now, what is safety margin? It's a difference between actual sales and break-even sales. All right, you'll see what we are talking about when we do the graph. You will understand. So what's a formula? There are two formulas to calculate safety margin. It's either we use the formula to calculate the rand and the formula to calculate the percentage, the safety margin in rands, safety margin percentage. Right, let's start with this one. When we calculate the rand, what's the formula do we use there? We take our sales, okay, sorry, we take our sales, we minus the break-even value. Remember the break-even value that we calculated from the previous slide? Okay, you just take your sales and then you minus your break-even value. Whatever is left is your break-even. It's your safety margin in rands. All right, and then how do you calculate your safety margin as a percentage? You take your sales, you minus your break-even value, okay, you divide all that by the sales, you multiply by 100, and then you'll get the safety margin as a percentage. All right, I wish we can do a question paper together so that you can see how easy this is. Okay, let's go to the next slide. Right, now we are going to do the graph. We have done the break-even quantity, the break-even value, we have done safety margin. Now we are going to present what we have calculated, to present it graphically. We are going to show it in a graph. So before you do anything, before you draw your graph, these are the things you need to show in your graph. You have to show your break-even quantity, your break-even value, your fixed costs, your variable costs, your total cost, your total sales, your profit, your loss, and safety margin. You have to show those things in your graph. right? You have to show those things in the graph. Okay, so sometimes they will ask you to calculate break-even quantity, break-even value, safety margin, and then they say use that information you have calculated to draw this graph. Okay, it's a pity now you are not here. We were going to do a question paper so that you can see how to plot that in a graph, but we are just going to do now a skeleton of the graph, of the break-even graph. So let's go to the next slide. Remember, please, these things, they must be in your graph. Okay, next slide. Okay, now these are the steps for you to draw the graph. These are the steps for you to draw the graph. We all know the graph has two axes. You must have your y-axis. You must have your y-axis. Okay, this is your x-axis. This is your y-axis. All right. Now on your y-axis you have your rands. You have your rands. It's money. It's money. Okay. Okay, let's just put it as you have your rands. Let's just say you have your costs. Okay, and then remember on your x-axis you always have your units or quantities, or units or quantities, right? And then where your y-x meet your x-x is what? Is 0, isn't it? It's 0. Okay, where they meet is 0. So you have units this side, you have money this side, right? And then that's your first step. You draw and label your horizontal, which is horizontal x-axis, and your vertical axis. Your x-axis, your x-axis will be they represent units produced. Okay, these units are actually units produced and units sold, right? Units produced and sold. Okay, and then your y is for rents or costs. Where they meet is 0. Here, where they meet is 0. Okay, now remember from the previous slide we said there are those things that must be presented here, right? The first one is your, okay, to advise you must always start with this one. Your first one will be your, okay, let me take the bold one. The first one will be your total fixed. Okay, so total fixed cost. Okay, so total fixed cost is a total fixed cost. Okay, always start with this one because it's simple. Total fixed, something that is fixed does not change. Okay, so whether we produce and sell how many, the cost remains the same, right? Total fixed cost. And then the second easiest one, okay, is this one, is your total cost. It does not start anywhere else. It must always start from here, from the total fixed cost. Your total cost must always start here. Okay, it must always start here. That's your total cost. That's your total cost. That's your total cost. It always starts from your total fixed. And then this space here, this between total cost and total fixed cost is your total variable cost. All this area in between, okay, all this area is your total, okay, sorry, this is your total cost, and then this area right here, this area right here, between your total fixed and your total cost, it's your total variable cost. Total variable cost. Total variable cost. Right. Okay. And then the next one will be your total sales. Next one will be your total sales. Your total sales will always start at 0, guys. Always start at 0. And then it goes up there. Goes up there. Okay. So that's your total sales. Right? Right. That's your total sales. Now, where is the break-even point? Okay, whereby we don't make profit and we don't incur any loss. Where is the break-even? It's when your sales equal to your cost, isn't it? When your total sales equal to your total cost. Where do we see it here? Where your total sales meets your total cost. So right here where they meet or where they cross is your equilibrium point. Okay, it's your equilibrium point right here. Right here, this is your equilibrium point, meaning at this point we are not making any profit, we are not incurring any loss. Okay, now at this point, at equilibrium point, you go down. Remember, these are quantities, ne? This side, this is quantity. So this is your break-even quantity. Break-even quantity. Okay. We break even at this point, so this is your break-even quantity. We break even at this point, so this is your break-even value. In terms of money, let's say this is 50,000, whatever amount. Okay, 5,000. Let's say it's 5,000. Right? Can you see? At break-even point, you will have your break-even quantity. You will have your break-even value. Right? Now, what's the other thing that we said we need on the graph? We need to show the profit, the loss. Okay, now we must take note that from the break-even point going up or above break-even point, the business is making profit. Okay, why do we say that? We all know that profit is when your sales are more than your cost, isn't it? So let's look here. This is a total sales graph, right? This is a total sales graph, and then this is the total cost graph. Okay, so at this point, at break-even point up, we say we're making profit. Why? Because the total sales curve is above the total cost curve, is greater than graphically. That's how we interpret it. The sales total sales is above this one, right? That's why this is here. At this point we are making profit. Okay, so at this point we are having profit. I'm just gonna write P, profit, PR. So from break-even point above, we're making profit as a business, but from the break-even point going below, the business is incurring losses. The business is incurring losses. Why do we say that? The business incurs loss when its costs are more than its sales, isn't it? So let's look at it graphically. From this point, which graph is above the other? See, total cost is above the total sales one. That's why you have loss. Okay. Now, what's the safety margin? We said the safety margin is when the business is starting to make a profit. So at this graph, we start making a profit. We were making a loss, and then we broke even. Then after breaking even, we started making profit. So after this break-even quantity, if we say the break-even quantity is 20,000, if we sell 20,001 units, then we are starting to make a profit. That's safety margin, right? So the safety margin is after breaking even, right? Let's say we sell this break-even quantity, let's say it's 20,000 units, and then we sell, say, 21,000 units. Let's say here 21,000 units we sell, 21,000 units we sell, and then because we have sold that, we receive how much money in sales? Let's say we receive 10,000. Receive 10,000. Okay, because we have sold 21,000. Right. So this area here, if we want to interpret this area here, that's when we calculate our safety margin in terms of units. And this area here, how much is the safety margin? Is 10,000. That is actual sales that we have made minus a break-even value. Okay, so our safety margin in terms of rent will be 5,000 rents. If the safety margin in terms of units will be 20,000 minus 21,000 is equal to 1,000. Right. Okay, guys, I wish you were here so that we can do the question papers. This thing is so simple. It's so simple. I hope you understood all this. Okay. All right, let's go to the next slide. Okay. Okay, let's first explain this. Remember, we said the first thing you do is to do the axis and draw the total fixed cost. After that, you draw the total cost, which starts from this one. We should never start at zero, but at the fixed cost line. So the difference between the total cost and the fixed cost will be your variable cost. And then after that, you draw the total sales, which will always start at 0. Okay, we already explained that. And then this is the graph that I've just drawn for you. Okay, we said the first thing that is important is that you draw your axis, your x-axis, which represent your money, and then this is your y-axis, and then your x-axis will represent the units or the quantity. Okay, put a 0 there when they meet. The first graph you must draw is the fixed one. Okay, you draw it because it's fixed. It means that whatever units we produce and sell, it doesn't matter. The cost remains the same. Okay, and then the second graph you need to draw is the total cost, which always starts from the fixed cost. Okay, it always starts here and goes up, right? And then the third thing is the difference between these two will be your variable. This part is your variable cost. And then the last, not the last one, the fourth thing that you need to do is your okay, let's take this one, is your sales, is your total sales graph, is your total sales graph, which must always start at 0. And then I don't know what happened here. It was here, this curve. Okay, it must go up there, yeah. Okay, so your total sales graph. Okay, and then when you are done with this, when you are done with all these curves or lines, you must determine where your break-even point is. Your break-even point will always be where your sales equal to your cost. That means you are not making any profit, you are not incurring any loss. So where your total cost crosses or meets the total sales is where you break even. So this is your break-even point, meaning that you will have your break-even quantity at B, quantity this side, and your break-even value because it's rands this side, right? After that, you must determine the profit or loss. Okay, so we said you start at the break-even point. We said the area above the break-even point is your profit because your sales are greater or above the cost, right? And then we said from the break-even point below you'll be incurring losses, meaning your cost, okay, from here your cost is above or is greater than your sales, so you are incurring losses. All right, and then we said about the safety margin. We said any point beyond the break-even point will be your safety margin, right? So let's say here we sold C units of goods. Okay, let's say 21,000 in that example. We sold them, and then because we sold them, we received this amount of money. Okay, we received this amount of money. Let's say this amount of money is D. Okay, so where is your safety margin? Your safety margin in terms of units, your safety margin units is the point between B and C, right? Okay, if for instance your break-even quantity was 20,000 and the units you actually sold is 21,000, then your safety margin will be C minus B. That means 21,000 minus 20. So your safety margin in units is 1,000 units. Here, if the break-even value here was 50,000, and then because you have sold 21,000, then we receive 52,000 rands. What's your safety margin in terms of rand? Will be your 52,000 rand minus your 50,000 rand, which is 2,000 rand safety margin in rands. Okay, I hope guys this is clear, and this should be the end of it. You need to know these calculations. You also need to know how to draw the break-even graph. Okay, and then guys, that's the end of it, and that's the end of the syllabus, and thank you very much.